All right. Well, hello and welcome to our Gould Asset Management webinar. I want to apologize for the technical difficulties we were having earlier. I don't think you guys can see me, but hopefully you can hear me. I don't seem to be able to start my video, but you know what? You can imagine what I look like. I've had enough difficulties, so we're going to keep going on with this. I really appreciate so many of you persevering. It looks like we still have a great turnout despite getting a little bit of a late start. Really quick, my name is Scott Smith. I'm a senior portfolio manager and partner here at Gould, and I will be serving as the host for today's discussion. In today's webinar, Don Gould, our company president and chief investment officer, will be talking about some of the current tax law change proposals and how you might prepare in the event some of these proposals become law. Like I said, it looks like we have a great turnout despite the late start, and I want to thank everyone for taking time out of their busy schedules to join us. It's going to be a very interesting and insightful 45-minute chat with Don, and we look forward to fielding questions from the audience at the end of Don's prepared remarks. If you'd like to submit a question to Don, you can do so at any time during the webinar. You don't have to wait until the end. We'll be using Zoom's Q&A feature, which you should see at the bottom of your screen. Please post all questions there, as we will not be using the chat functionality to respond to questions. A couple of other quick housekeeping items before we get started. First, we are recording today's webinar, so if you had difficulties connecting or know someone who did, don't fret. We will make that replay available shortly after the completion of today's call. So if you have to leave early or you happen to get disconnected, don't worry about it. You'll be able to catch up. Finally, we are targeting today's webinar to last approximately 45 minutes. In the event we don't get to answer your question live on air, we will have a member of the Gould team follow up directly with you in the next day or two to make sure we get all of your questions answered. I think that's it. So with no further ado, let's turn it over to Don. Take it away, Don.
All right. Can you see me? I'm going to assume yes. Well, again, apologies for the technical difficulties. We've done a number of these Zoom webinars in the past without any problem, but for some reason today the link didn't work. But glad to see so many of you there today. And thank you, Wendy, for letting me know that you can see me. That's reassuring. Okay, so I've got a number of items I'm going to cover today, and I'll just recite the main bullet points to you and then get into it. But I have to start with a caveat. Our lawyers insist that I remind you that while we have a very good understanding of the interplay between investments and tax rules, we're not tax advisors. And so the usual disclaimer, consult with your tax advisor before taking tax-related actions. All right, so the outline is as follows. I'm going to first give the political background that we're seeing that is sort of, it's very important to understand if you're going to understand what's likely to happen in the next few weeks with the tax bills. Then I'm going to cut right to the bottom line, because I know for some people, getting into the details of tax law, it ranks right up there with getting a root canal. So I'll cut right to the bottom line, and then the rest of the webinar will be going into the detail about how we get to that bottom line. And then finally, we'll open it up for Q&A. So I'm going to talk about corporate taxes, taxes on ordinary income, taxes on capital gains, state and local tax deduction, charitable deductions, estate tax, Roth conversions, exchange traded funds, and some potential action steps. So let's get right into it. The politics. President Biden promised to raise taxes on corporations and on the rich. However, the rich are defined. This was a major plank of his campaign. And if you think of tax law as like a pendulum, the pendulum swung pretty heavily in the direction of lower taxes with the 2017 tax bill that was passed during the first year of the Trump administration, when Trump was president and when the Republicans had control of both houses of Congress. What we're now seeing with Biden as president and with Democrats having very slight control of both houses of Congress is the pendulum swinging back somewhat, but I would say not nearly as far as to the point it was before the 2017 law. Biden's original proposals came out probably 2 or 3 months ago, and they surprised people with how aggressive they were. Although Biden is viewed as a centrist Democrat, the proposals were really not far off the positions of Bernie Sanders. And Sanders obviously is considered to be on the far left of the political spectrum. But the proposal was clearly just a starting point. And this gets to the main point about the political backdrop. The Democrats have a tiny majority in the House and the thinnest possible majority in the Senate. In the House, they have a 3-seat majority. In the Senate, it's a 50-50 tie, and that tie is only broken by the vote of Vice President Kamala Harris. 100% of Republicans in both the House and the Senate are expected to vote against any tax bill that is proposed by the Democrats. This situation, the small majorities and the fact that no Republicans are likely to vote in favor of any tax bill, gives tremendous power to any Democrat who is willing to withhold his or her vote in favor of the tax plan. So in the Senate, all eyes are on Joe Manchin, senator from West Virginia, and Kyrsten Sinema, the senator from Arizona, who are considered moderates and who have indicated that they're not likely to support the proposals in their current form. So consequently, the actual tax bill that makes it through Congress will be one that Manchin and Sinema will both back, meaning that tax increases are likely to be far less significant or substantial than the original Biden proposal. There's also no guarantee that any bill will pass, but our reading is that enactment of a new tax law at this point is more likely than not. I'm going to discuss what we think the bill is likely to contain, but please keep in mind that none of this is law yet. So the House Democrats have put forth a plan. It's over 700 pages. It's available for reading online. The Senate Democrats have not yet put out a plan. They are still arguing among themselves as to what their version of a tax bill will look like. The two tax bills will definitely be different from one another. And so once the Senate Democrats have their bill actually in writing, which I think is expected in the next few days, the House, the Senate, and the White House will all then have to negotiate to try to find a common ground. And all the while, well, under bombardment from all sorts of lobbyists, right? Because that's the way Washington works. I think of the end result as going to be sort of like a lowest common denominator. It's going to be something that all these disparate parties can agree to. And that in general means probably less taxes rather than more. Now, why a tax bill right now? Because Biden has proposed a $3.5 trillion spending bill to tackle all sorts of commitments that he made during the campaign. And so the idea is, well, we need to raise taxes in order to pay for this. You keep hearing this statement: the spending bill must be paid for. It's a little funny to hear that now, given that we've seen many trillions of dollars of bills since the beginning of the pandemic that apparently did not need to be paid for. So it's a bit selective these days as to what needs to be paid for. Now, you may ask, well, how can you spend money and not pay for it? It's actually rather simple. You print money, and the net result is that there's more money in circulation, and arguably each dollar has a little bit less value because it's being diluted over a larger finite quantity of goods and services. But apparently they want this bill to be paid for. Now, it turns out that a big chunk, nearly $1 trillion of this bill, of this tax increase, is coming through something to do with pharmaceutical pricing. So, you know, when it comes to actual tax increases on individuals, it may be less than you were expecting. Okay, the bottom line, assuming a bill is passed into law, for the vast majority of households, and by vast majority, I mean individuals with a net worth under $6 million, households with a net worth under 12 million, and frankly, you could probably double those numbers to be more realistic. Households with individual incomes under 400,000 or joint incomes under 450,000, there will be no increase in taxes for any of those groups. Now, for most of the households above those numbers, there would be modest increases in annual income taxes and potentially a large increase in estate taxes due at death, but again, only for the very largest, highest net worth households. I do want to point out that there is a large marriage penalty built into the proposals. And by that, what I mean is that two people living under the same roof who are married may potentially pay much more in income tax than two people living under the same roof, earning the same incomes, but who are not married. And specifically, as I mentioned, for individuals who are earning more than $400,000, higher tax rates would go into effect. For joint filers with combined income of over 450, they would, that's the point at which higher taxes would go into effect. So what it means is that in theory, you could have two people who are living together but not married, each earning $400,000, summing to $800,000, neither of which are going to be paying higher rates under the proposals. Whereas if they get married, the 350,000 excess over the 450 would be subject to the new higher rates. Some taxpayers in high tax states like California, New York, New Jersey might even see lower federal tax bills, and I'll get to why that might be. But I would say that the biggest effect on people watching today is most likely to be indirect. And that is specifically that we would expect some indirect negative impact on stock prices. All right, so let's talk about the elements of the plan. And again, there's a lot of plans and a lot of disparate pieces out there. We're telling you what we think is most likely to be enacted. First, the corporate income tax. The corporate income tax was cut in the 2017 bill from 35% down to 21%. So that was a huge cut. What's now being proposed is to increase that number back to somewhere between 25% and 26.5%. And unless you happen to yourself be running a corporation, you're not likely to be directly affected by this. But virtually all our clients own some stocks, either directly or through mutual funds, exchange traded funds, and an increase in the corporate tax rate will reduce corporate after-tax profits. And that means there will be less cash flow available for the corporation to use for the three major things that corporations use cash flow for. One is to pay dividends to shareholders. Second is to use the cash to make open market repurchases of their stock, which is sort of an indirect and more tax efficient way of returning money to shareholders. Or the third thing is to reinvest that money into the business. So there will be less money for any of those things, and all those things make a stock less valuable. So other things being equal, corporate tax increase should reduce the price of stocks a bit. We are probably already seeing some of the effects of this in the stock market's recent weaker performance, not just today, but over the last few weeks. I'll come back to that a little later. So the corporate tax rate, interestingly enough, is the one that I think will affect the largest number of people who are watching this call today. The income tax increases, on the other hand, are going to affect a relatively small portion of viewers and of our clients. On the ordinary income side, ordinary income is defined as your wages or your 1099 work income as an independent contractor. It also includes interest income on taxable bonds, such as government, corporate bonds, or CDs, bank interest. The proposal, and I believe will happen, is that the maximum tax bracket will be raised from 37% to 39.6%, which precisely reverses the decline that occurred with the 2017 bill. But again, this only applies to those households that are above the $400,000 or $450,000 income level. And so those households will pay more tax on their earned income and on their taxable interest income, but not hugely more. Again, from 37% to 39.6%. This does make municipal bonds relatively more attractive as a result, but municipal bond yields are already so low, there's really not much opportunity, in our opinion, to shift from taxable bonds to municipal bonds. Tax deductions such as charitable donations will be worth a little more, but only if you are itemizing deductions. And I'm going to come and talk more about charitable donations in a couple minutes. The effective date of all these things is unknown. The betting is that the effective dates will either be the date of enactment or January 1st, 2022. Personally, I think January 1st is more likely because we're getting to a point where it's so late in the year that it's really hard to justify the immense problems that a mid-year tax rate change would cause. But maybe that's wishful thinking on my part, but that's my betting. Okay, so ordinary income tax rates going up a bit, but again, only for the highest income households. Capital gains. Currently, long-term capital gains are taxed at 20%. I believe that rate will rise to 25%. A long-term capital gain is a profit on a sale of a security or another asset held more than 1 year. Short-term capital gains are treated as ordinary income, so their rate would go from 37% to 39.6%. But again, this only applies to those highest income households. One other point worth noting, most stocks pay what are called qualified dividends. Qualified dividends are taxed at the long-term capital gains tax rate. So in this instance, the taxes on qualified dividends at the federal level would go from 20% up to 25%. Very importantly, Biden's original proposal included a provision that unrealized capital gains would be taxed as if there were a sale at the time of death. So for example, if somebody had a $3 million stock portfolio with a cost basis of $1 million, and therefore a $2 million unrealized gain, at their death, the estate would have to pay a capital gains tax on the $2 million gain. That proposal did not make it into the House version, and there's no evidence it will be in the Senate version. That would have been a nightmare for accountants and everyone else. It also would have meant a tremendous amount of additional taxes for a lot of people. So I think people are relieved that that was not included in the proposal. Okay, now let's talk about the SALT deduction, the state and local tax deduction. Prior to the 2017 tax bill, income taxes, let's say that you paid in California, were fully deductible on your federal tax return. And taxes in California and places like New York are so high that this was a very substantial tax deduction for a lot of people. The 2017 bill put a cap of $10,000 on the amount of the deduction, which for a lot of people was essentially like eliminating the deduction. This was viewed both as a way to raise revenue to compensate for revenue that was going to be lost from the corporate tax cut and the income tax cuts. There was also a political element to it, since generally it's the blue states that have higher state income tax rates. It was the blue states that did not vote for Trump, that did not largely vote Republican. And so, at least from the blue state point of view, it felt punitive. Now that, you could say the blue states have a slight majority in Congress and there is a Democratic president in the White House, there is the possibility that some or all of this will be reversed. It has not been included in the House proposal. But if you go back to what I said earlier about the politics, it only takes a couple congresspersons from New York, New Jersey, California to band together to basically be able to dictate that in order for the Democrats to use their majority in the House on a tax bill, they would have to include some rollback of this limitation on the SALT deduction. So despite this tax bill's general goal of raising revenue, the SALT limitation could be raised or repealed altogether, which would have the opposite effect of raising taxes. It would cut taxes. I would say the most likely outcome is that they will raise the cap. I don't know how much, but if I had to pick a number, I'd say 50,000 is the most likely case. 25,000 is a possibility. Some are also talking about a temporary repeal of the cap, say for 2 calendar years. I think what's least likely is a full and permanent repeal, simply because the revenue impact is huge. But if they raise or repeal temporarily the SALT deduction limitation, it would result in far more taxpayers itemizing their deductions. I saw a statistic recently that said that since 2017, the number of taxpayers who itemize deductions has fallen from about 37% to about 12%. So more than a 2/3 drop in the number of people who itemize. There's 2 reasons for that. One is the loss of this deduction, but the other is that the 2017 bill increased the standard deduction to $12,000 for individuals and $24,000 for joint filers. What that means is that unless you have itemized deductions as joint filers exceeding $24,000, it is to your advantage to simply use the standard deduction. So for those who itemize, raising or repealing the SALT cap will reduce their federal taxes because it will increase what they can deduct. It will also increase the number of people who are over the standard deduction limit. So it will increase the number of people for whom itemization makes sense. But even for households earning more than the 400 or 450,000, an increase in the amount of state and local taxes that you can deduct could save some taxpayers like in California, as an example, more in federal taxes than the higher tax rates will cost them. And even for those who are at the very top of the income brackets, it's estimated that reinstatement of SALT deduction would reduce the impact of higher taxes by about half. So this is a real important one to watch. Okay, let's talk about charitable deductions. As I said, there's a $24,000 standard deduction, and that's resulted in fewer people itemizing, which has meant that charitable deductions, for those who are, giving less than the standard deduction amount in a given year, effectively do not reduce your taxes anymore. For that reason, we have recommended to clients a strategy called bunching, which is to say, if you were going to give $50,000 to charity over a 3-year period, rather than giving, say, $17,000 a year for 3 years running, none of which would change your taxes because the 17 would leave you potentially under the $24,000 standard deduction, you could contribute $50,000 all in 1 year. And then you'd be substantially above the standard deduction threshold, and you would be able to reduce your taxes at least by that difference between the $50,000 and the $24,000. If the SALT limitation goes away, you might not need to do the bunching anymore because it will be easier for you to itemize each year. Okay, let's talk about the estate tax. The current lifetime exemption is, for an individual, is $12 million. For a married filing jointly couple is $24 million. What that means is that if you're fortunate enough to have that amount of money, you can either gift to, for example, your children or grandchildren during your lifetime or at death that amount without paying any estate tax on that amount. So this is the lifetime exemption. Under the current rules in place with the 2017 bill, which doubled these numbers from 6 million and 12 million, they will revert back to 6 million and 12 million in 2026. But under the proposed new tax bill, they will revert to those smaller numbers beginning January 1st, 2022. So just in a few months. I believe there's a high probability that this part of the tax bill will become law. But again, this change affects relatively few people. You have to have a very large estate. And frankly, it has to be substantially larger than even the $12 or $24 million numbers that I'm throwing around here for it to make sense for you to take any action between now and year end. Okay, a couple things to wrap up here. The exchange traded funds, there is a proposal on the table that would make exchange traded funds less tax efficient. It's unclear whether that will pass. Now, just to review, virtually all of our clients own some and many own a large number of exchange traded funds. They're a form of a mutual fund, but they have a lot of advantages over mutual funds. They're cheaper to transact. You can use them intraday, so you could buy an ETF at 10 and sell it at 11. You can't do that with a traditional mutual fund, which only prices once a day. So there's a number of benefits, and tax efficiency has been one of them. If this provision is passed, they will be less tax efficient, but they will still be as good or better than the alternatives. So we don't actually see anything that you can do about this, except perhaps tell your congressperson that you don't want to see ETFs made less tax efficient. Roth conversions. So Roth IRA is a special kind of IRA that is funded with after-tax money. The beauty of it is that the growth of the money is tax-free, not just while it's in the IRA, but when you pull it out, it's also tax-free. There are proposals that would prohibit the conversion of pre-tax IRAs to Roth IRAs, but again, only for those highest income households. And that's after 12/31. If you are one of those higher income households, you are probably in a high enough tax bracket that it may not make sense to do a Roth conversion anyway. And if you're not above that high income threshold, the rule will not apply to you. So this is mostly a non-event. Finally, I want to mention again this marriage penalty issue. This marriage penalty issue would apply to the ordinary income tax increase, the capital gains tax increase, and the Roth conversion rule. So I suppose it could be argued that economically, if you have a household with two high earners, they can pay less taxes if they're not married. I think that's a kind of ridiculous policy, but it is what it is. All right, action steps, and then I'll go to Q&A. The first thing I would say about action steps is you might want to wait until there is a bill that actually becomes law. We are talking about what we think is going to become law, but you never know. But once it becomes law, here are some steps you can take. And I think they're relatively limited. And the reason they're limited is because the impact of this tax bill is actually limited to a relatively small number of taxpayers. So the first action you could take is if you are sitting on a highly appreciated asset that you were already planning to sell, you might want to accelerate that sale into 2021. Hope that the effective date of the higher capital gains tax rate is January 1st of next year. So rather than waiting, let's say, till January to make a sale, you might want to make a sale in 2021. If you have income where you can control its timing, and this is not a common situation, but if you do, there might be an argument that you would want to accelerate that income into 2021 while tax rates are lower. But again, that's only for the highest income households. If you have deductions where you control timing, and here that's not uncommon, for example, with charitable gifts, you might want to defer that until you're in a higher tax bracket, if in fact the tax increases would affect you. As I said, you could consider a Roth conversion in 2021 while it's still permitted. But the fact is that because the elimination of the conversion only applies to the highest income households who are in the highest tax brackets, we generally don't recommend Roth conversions for people in high tax brackets. So that may be moot. If you have a very large estate, and I would argue 25 million or more, there may be a very strong reason to make gifts to heirs, probably through a trust structure in 2021. And we're happy to talk to you about that if that applies to you. Okay, so now I'm going to move to Q&A. Got some questions here. The first one has nothing to do with taxes per se, or maybe a little bit. And that is, what about today's stock market decline? In case you aren't watching the stock market minute by minute, the S&P 500 dropped 1.7% today. That's the biggest one-day drop we've seen in a while. The market is down about 4% from its all-time high. But to put that in perspective, that puts us back to about where the market was in mid-July when it reached an all-time high at that point. So these are not a massive decline, but what's going on? There are a number of, I will call them excuses, because the media is compelled when the market drops to explain it, even if there may not be a good explanation. So the excuses that are given are that the Fed is going to taper, meaning the Fed is going to stop buying as many bonds in the open market. The Fed's bond buying tends to keep interest rates low. Low interest rates other things being equal, tend to keep stock prices high. But the fact is, there's no news on Fed tapering today. Everybody knows the Fed's going to taper. Nobody knows when. But the point is that the best guesses on the timing of that taper have been baked into the market for a while. So I don't think that's what's going on. Higher corporate tax rates, I think, could be a factor here. Not that it's news today per se, but I think it may be sinking in that there will be less free cash flow for corporations to distribute as dividends or use for stock buybacks. So that could be a factor. There's a story about China, and specifically about a company called Evergrande, a home builder, which has accumulated $300 billion in debt and is now having trouble performing on that debt, meeting the principal and interest payments. It's a bit of a wild card. My best guess is that somehow China and the world will muddle through that one, but it's hard really to know. But that's certainly been an excuse that's being given for the market decline. I think there's a seasonal factor. I've been in the industry for decades now, and it seems to me that you get after Labor Day, the days start getting shorter, and I think moods on the market for some reason just change a little bit to the pessimistic side. So that might be a factor. Profit taking, let's face it, we've had an unbelievable run up since mid-March of 2020, a more than 100% gain in the broad market indices. I think you see a little bit of selling, and it probably triggers more selling because people think, well, I want to lock in these profits while I can. So I note that bond yields were down today. The 10-year Treasury dropped from 137 to 1.30. So bonds went up in price today. So for those who have balanced portfolios of stocks and bonds, which is pretty much all our clients, the rise in bond prices today provided some cushion against the decline in stocks. Correction, which is defined as a 10% decline, normally happens a couple times a year. We haven't had a correction since the very sharp but very brief bear market of early 2020 when the pandemic started. If this is the start of a correction, our advice will be to ride it out. You can't really time these things. People who do sell, number one, invariably incur tax liability. Number two, they have no idea when to get back in, nor do we. Usually don't get back in until the market is higher than the point at which they sold, defeating the entire purpose of the exercise. So we sound like a broken record, but stay the course, we do believe, is the best way to go. And on the topic of a bear market, our view is that the risk of a bear market is not elevated right now. Bear markets can happen at any time, and they can happen for reasons that come out of left field. They can happen for no reason at all, just simply a change in sentiment. But right now, the very low level of real interest rates, inflation-adjusted interest rates, suggest to us that there is no abnormal level of bear market risk at the moment. Okay, I've got another question here about the so-called backdoor Roth conversions, and will they be affected? This is a technical area, but suffice it to say, people who have income above a certain level are not permitted to contribute to Roth IRAs. However, there is a two-step process by which they can, if a certain number of requirements are met, and it allows those people to contribute between $6,000 and $7,000 a year into a Roth IRA, even though they otherwise don't qualify. The tax bill that's come out of the House would eliminate the backdoor Roth. And I don't think there's a lot of political support for backdoor Roth IRAs. And so my expectation is that would probably be in a final bill. One more question I've got, and then Scott, I'll see if you've collected any questions. Someone says, I've read that there's a potential workaround on the SALT deduction limit for California taxpayers? The answer is yes, there is, if your income is primarily derived from a partnership or an LLC, a limited liability company. Without any fanfare, in July, California put into place a law that allows those people who earn most of their income from profits from an LLC or a partnership, essentially a workaround the SALT cap deduction. The law is called A like Alpha, B like Bravo, 150. So you can ask your tax preparer about that if that describes your situation. And if it does, it actually allows you to effectively deduct the bulk of your California income tax against your federal return. All right, I'm going to stop there. And Scott, let me know if we have other questions.
I'm only seeing a few others, Don. First one was just sort of wondering if you know why the income levels of 400 and 450,000 were selected, and why not something higher or lower? Do you have any idea?
Well, I think 400,000 is the cutoff for being in the top 1% of income. So I think politically, the idea that we're only raising taxes on the top 1% and not on the bottom 99 is palatable. We have a midterm election a year from now. So I think that's where the number comes from. But the small gap between the 400 for individual and 450 for joint doesn't make a lot of sense, except for the fact that by keeping the joint limit as low as it is, they will raise a lot more tax revenue.
Great. And then I'm only seeing one more. If anyone's got any other questions, feel free to pop them into the Q&A box there real quick, and we'll try to get to it. This question has to do with the execution of stock options, Don. I don't know if you've seen anything in the tax law that relates to that, but it says, do we foresee any problems with the execution of stock options greater than $100,000 if the new tax law passes?
Well, there are all sorts of types of stock options. You know, there's the options that you can buy on the public markets, just like you would buy any stock. And I'm not aware of anything that would affect publicly traded stock options. Then there are options that are issued by companies to employees as a form of compensation. And those fall into two different categories. And the rules that apply to both of those are quite complex. I'm not aware of anything in any of the tax proposals out there that would affect those, but I will have to also say that I have not focused on that issue, so I would not take that to the bank. It's something you probably want to ask your tax advisor about.
Great. I think that wraps it up. Don, I don't see any others.
Okay, well, again, our apologies for starting late. Thank you for hanging in there with us. We appreciate your participation. As Scott mentioned at the outset, this will be available on replay, and we'll be sending out a working link to the replay here in the next day or two. Wishing you all a good end of summer and a healthy and happy fall. Bye-bye.